Why the stock market hasn't crashed yet. Imagine standing on a quiet shoreline just before a storm. The air is warm, the sky is calm, and yet far in the distance something is shifting, an invisible pressure building, a tension in the atmosphere that only the most attentive observers can feel. That is the moment we are living in right now. The world looks stable, even prosperous. Markets hover near record highs. Investors celebrate another year of gains. And yet beneath this calm surface sits one of the most overextended, distorted, artificially propped up financial systems in modern history. A system whose cracks are hidden in plain sight. A system that, according to every major historical indicator, should have already collapsed. So why hasn't it? Why has the long-awaited crash failed to arrive? Why do the pressure points keep building without releasing? And most importantly, how long can a system defy gravity before the fall becomes inevitable? To understand why the financial crash has been delayed, we must begin by looking at the sheer absurdity of the moment we're living in. Because at no point in history, not in 1929, not in 2000, not in 2008, have markets been this disconnected from economic reality. Start with the simplest signal, the Buffett Indicator, total stock market value divided by the size of the entire economy. For decades, this indicator has averaged around 80 to 100%. When it crosses 150%, history shows a crash typically follows. Before the dot-com collapse, it hit 150 and the NASDAQ later fell 80%. Before the 2021 bubble burst, it hit around 200%. Today, depending on the estimate, we are sitting at 220 to 230%, an extreme multi-sigma outlier. The kind of reading that should precede a violent and unavoidable correction. Yet the market marches higher. Price to earnings ratios tell the same story. For decades, the S&P 500 traded in the mid-teens. Today, valuations sit in the mid-20s, and the top AI-driven mega-cap companies trade at even more stretched levels, assuming decades of perfect execution and uninterrupted growth. A handful of companies now carry nearly half the weight of the entire S&P 500. That level of concentration is not diversification. It is fragility disguised as strength. All the while, government debt sits at levels once considered unthinkable. Interest costs soar. Real economic growth slows. Inflation may have eased, but it was never defeated. It merely retreated behind a wall of policy intervention. If financial markets followed economic fundamentals, the correction would already be behind us. But it isn't. Because three massive structural forces, three invisible pillars, have held the market aloft far longer than anyone expected. And these forces don't eliminate the crash, they only delay it. In fact, each day of delay makes the eventual break more severe. The first force is the most obvious, yet the most misunderstood. The fire hose of government spending and the quiet debasement of money. Since 2008 and again through the pandemic, policymakers have pumped trillions of dollars into the financial system. New money enters not through the hands of ordinary workers, but through banks, asset managers, primary dealers, the institutions closest to the source. This is the Cantillon effect in modern form. Those first in line for new liquidity benefit enormously, seeing asset prices rise before the rest of the economy catches up. Stocks, bonds, real estate, private equity all surge as a result of this engineered liquidity. But here's the uncomfortable truth. This is not prosperity. This is a transfer of wealth, a redistribution from the late receivers of money, wage earners, savers, to the early receivers, the asset owners. And the longer this mechanism persists, the more distorted the system becomes. Asset prices climb far above their true value. Wealth inequality accelerates. And while the underlying economy stagnates, financial markets inflate into a bubble so large, it becomes a risk of the entire system. Banks and policymakers rarely admit this openly because the implications are explosive. To say plainly that new money enriches the financial elite first, and everyone else pays through inflation later, would expose the underlying fragility of the system. So instead it is framed with sanitized language. Liquidity support, market stability, accommodative policy. But beneath these words lies the same mechanism that has been pushing markets higher long after fundamentals justified the move. The second force delaying the crash is the AI-driven market concentration fused with the rise of passive investing. AI has become the story of our time, part technological breakthrough, part speculative frenzy. The largest companies in the world now revolve around AI, and investors have priced in not just future profits, but decades of exponential expansion. This funneling of narrative and capital into a small cluster of mega cap companies gives markets the illusion of strength. Even when the broader economy weakens, these companies keep the index levitating. But the real accelerant here is passive investing. In recent years, passive funds have overtaken active funds, controlling more than $16 trillion. When money flows into an index fund, the fund does not evaluate companies or assess risks. It simply buys in proportion to market weight. That means the largest companies receive the largest inflows, automatically, mechanically, relentlessly. And so the winners keep winning, not because of fundamentals, but because the structure of the market forces more capital into whatever is already big. This creates a feedback loop. More flows raise prices, rising prices increase index weight, greater weight attracts more flows. A reflexive spiral that keeps markets elevated far beyond what a healthy market would support. Until, of course, the flows reverse. And when they reverse, the same mechanism that lifted markets will accelerate the fall. In a downturn, passive funds will be forced to sell the largest names first, creating a cascade that hits the most overvalued stocks hardest and fastest. The third force delaying the crash is the least visible, yet perhaps the most dangerous: the migration of risk into the shadow banking system. After 2008, regulators tightened the rules for traditional banks: higher capital ratios, stricter balance sheet requirements, stress tests. On paper, the core banking system looks safer today. But risk did not disappear, it simply moved into the shadows. Hedge funds, private credit funds, structured vehicles, money market funds, fintech lenders, together now hold more than $200 trillion in assets globally, much of it tied to leveraged credit. This sprawling, loosely regulated ecosystem acts as the shock absorber of the modern financial system. When risky loans start to crack, the damage is absorbed here first, out of public view. Banks appear stable, even healthy. Regulators point to strong capital ratios. The public sees no obvious sign of crisis. And this illusion of stability delays the reckoning. But when losses accumulate beyond a certain threshold, the shadow banking system becomes the transmission mechanism for systemic crisis. Because while these institutions are technically outside the regulated core, they are deeply interconnected with the banking system through derivatives, collateral chains, and funding markets. When the pressure finally snaps, it will not be contained. It will cascade rapidly, revealing that the seemingly safe banking system was standing on the shoulders of highly leveraged, structurally fragile actors all along. Meanwhile, human psychology reinforces this delay. Every month without a crash strengthens the belief that perhaps the warning signs are false alarms. Perhaps this time really is different. Investors become numb to risk. Analysts downplay threats. And the longer the instability persists, the more people assume it isn't instability at all. Yet history teaches the opposite. Crashes do not happen when markets are weak. They happen when markets are euphoric. They do not strike when investors are fearful, but when they are complacent. The danger lies not in panic, but in confidence. Confidence built on foundations too brittle to support it. But if the system is so stretched, so fragile, so full of contradictions and unresolved imbalances, then what is holding it together right now? What invisible force prevents it from breaking? To answer that, we must travel back to the moment the normal economic cycle was interrupted, the pandemic era. In early 2020, markets convulsed. The global economy braced for impact. And in response, central banks launched the largest liquidity intervention in modern history. In the United States alone, the Federal Reserve's balance sheet more than doubled, from under $4 trillion to over $8.7 trillion. Interest rates were slashed to zero. Emergency lending facilities were deployed across corporate debt, municipal bonds, and small business payrolls. This was not just stimulus, it was a structural rewrite of the financial cycle. In 2008, it took years for central banks to inject $3 trillion into markets. In 2020, they injected more than $4 trillion in a single year. Globally, central bank balance sheets ballooned to over $30 trillion. And although markets recovered quickly, the effects of those interventions continue today, distorting every major financial signal. Yield curves, credit spreads, default rates, all have been rewired by unprecedented policy intervention. Within the Federal Reserve, this sparked a quiet internal conflict. On one side were the doves, arguing that removing support too early would trigger depression-level unemployment. On the other side were the hawks, warning that suppressing defaults and flooding markets with liquidity would store up risk for later, compressing the normal cleansing cycle and creating a backlog of fragility. The hawks were right. By delaying the downturn, policymakers allowed weak companies, weak loans, and weak balance sheets to survive far longer than they should have. They built a thin layer of calm atop a deep reservoir of unresolved risk, and eventually that risk began migrating into even more dangerous corners of the financial system. The first visible leakage appeared in the bond market through the yield curve inversion of 2022. Historically, every U.S. recession since 1955 has been preceded by the signal. And yet, because years of extreme intervention distorted the bond market, many analysts dismissed the warning. But beneath the surface, investors were repositioning. Large funds shifted into short-term treasuries. Household debt climbed toward 80% of GDP. Nearly a third of middle-income households admitted they could not cover like a $400 unexpected expense without borrowing. These were not signs of resilience. They were signs of pressure building behind the dam. At the same time, commercial real estate quietly deteriorated. Vacancy rates soared. Defaults doubled. Nearly $1 trillion in commercial property loans are set to mature in 2025 and 2026, many issued during the ultra-low rate era, now underwater as property values decline. More than 1,700 regional banks hold commercial real estate exposure at levels 3 to 5 times their total equity. In 2023, the collapse of a single mid-sized bank with heavy office loan exposure sent shockwaves through financing markets, freezing credit and forcing fire sale liquidations. This is the same pattern that unfolded before every modern financial crisis: a denial phase where problems appear contained, a contagion phase where they spread, an intervention phase where policymakers attempt to stabilize the system, and finally a secondary decline when those interventions fail to address the underlying weaknesses. We are currently at the end of the denial phase. The signals are here. The pressure is visible. The timeline is converging. The only missing piece is the trigger, and here lies the paradox. The very forces that kept the crash from happening are the same forces that make the crash more severe when it finally does. Government liquidity delayed the fall, but inflated valuations to levels that cannot be sustained. AI concentration delayed the fall, but concentrated systemic risk in a handful of companies whose decline would drag down the entire index. Passive investing delayed the fall, but transformed market flows into a fragile one-way system disconnected from fundamentals. Shadow banking delayed the fall, but buried the riskiest assets in unregulated corners until they explode all at once. This is why the crash hasn't yet occurred. Not because the system is healthy, but because it is overstimulated, propped up, temporarily insulated from consequence. But every breaker eventually flips. Every delayed correction eventually arrives. And history is clear. The longer the delay, the more violent the release. To understand what comes next, look to the cycles that govern economic history. For more than 2 centuries, researchers have identified long waves, patterns in investment, credit, innovation, and land prices that repeat with remarkable regularity. Kondrativ waves spanning 50 to 60 years. 18-year land cycles predicting property swings with uncanny accuracy. These cycles have no interest in human opinion. They do not bend to political pressure or investor optimism. They march forward, indifferent to disbelief. The land cycle peaked in 2006. 18 years later points directly to 2024 to 2026. Commercial real estate stress, yield curve signals, debt saturation, corporate earnings compression, they are all aligning with this historical rhythm. The timing is not mystical, it is mathematical. And whether the trigger is a default, a bank failure, an earnings shock, or a geopolitical crisis, the system is now fragile enough that any spark can ignite the cascade. Yet within this unfolding storm lies the most important truth of all. The crash is not a random disaster. It is the consequence of years of delay, distortion, and imbalance. And it is also the beginning of the next cycle. Crashes are destructive, but they are also cleansing. They clear out excess, remove weak institutions, and reset valuations. They create the conditions under which new growth becomes possible. And this is why understanding the delay matters, because the longer the system postpones the necessary correction, the larger the opportunity becomes for those who can see the pattern clearly. Crashes destroy the unprepared, but they create generational wealth for those who anticipate the cycle, position early, and act decisively when the moment arrives. Right now, the world looks calm, but calm is not safety. Calm is the silence before the break. And when the pillars holding up this market finally shift in the same direction, when government liquidity, market flows, and shadow leverage stop supporting the system and begin pulling it down, the illusion will shatter instantly. The secret will no longer be a secret. It will be visible in plunging prices, frozen credit markets, and headlines insisting that no one could have seen this coming. But the truth is clear. Many saw it. Many understand the cycle. Many recognize the signals. The only question now is who will be ready when the delay ends and the real cycle begins.